So we go to changes in partnership. When we talk about changes in partnership, changes may occur as a result of a partner retiring or addition of a new partner, or probably a partner is bringing in new assets into the business. All these will change the face of the agreement. So as soon as there's changes in partnership, it means there will be termination of the existing agreement. That is what changes in partnership will bring about. We have an agreement, there's an original agreement which is fixed. But as soon as there are changes that are made, so it means the existing agreement has to be terminated.
And new partners.
Not really for new partners. Whatever happens that would bring about changing the terms and conditions of the agreement means that agreement has to be terminated. So the termination of agreement will be done with revaluation. So that is where we're going to, revaluation of assets. So yeah, changes may occur as a result of retirement of an existing partner or an addition of a new partner. At this point, there will be termination of the existing partnership agreement, which will result in revaluation of assets. So why do we revaluate the assets? We need to revaluate the assets so that we can as well transfer whatever the worth of the business is to the capital account of each partner. That is why we're doing revaluation. So the capital account will be equal to the net worth of the business, then transfer to the capital account, which I just told you now, of the partners according to their share of profit. So now, the value of that business now, the worth of the business is what the capital in the business right now becomes the worth of the business. And it will now be transferred, it will be shared according to the share of profit made in that existing, the defuncted or the now terminated agreement. That is how it will be shared. So what is the purpose of revaluating the assets? The purpose is to allow existing partners to share in the profit or loss. So we're doing revaluation so that if we are making a loss, the partner has to share from it. And if we are making a profit, he or she needs to get the reward for that. Is it clear?
Yeah.
So that takes us to admission of a new partner. So for admission of a new partner, as soon as a new partner is admitted into the partnership business, into the partnership, the evaluation process takes place. This should be done to illustrate a fair view and the true worth of the business. Why do we evaluate? We have to think about, accounting is done in a way that it has to represent the fair and the true value of the business. That's why we have our statement of financial position. The statement of financial position should tell us the worth, the true value of what the business is. So that is why we are doing the evaluation. So the book value may be lower than the going concern value. So what's the difference between the book value and the going concern value? As soon as there's admission of a new partner, there's a goodwill that is in place. And when we talk about goodwill, we simply talk about the reputation of the business, the valuable customers the business has. These are things that makes the business to stand out.
Yeah.
Whatever has added value to that business is called goodwill. So this goodwill, because there's a new partner that is being admitted, the termination of the old agreement has to go. Yes or no? So because a new partner is coming in, the goodwill of the business before the new partner has to be taken away.
Yeah.
So because the new partner is just coming, he has not added or she has not added any goodwill to the business. So the existing goodwill has to be distributed among existing partners.
Existing partners, okay.
Do you understand?
Yeah.
So that's why the going concern value will be lesser than the book value.
Mm-hmm.
Here I go. The book value will be lower than the going concern value because the going concern value has goodwill, but it has to be taken away. Do you understand? So taken away from the goodwill, as a result, the goodwill taken away from the business as it's credited to the account of existing partners, as a reward for bringing reputation into the business and value and the valuable customers it brings. So the goodwill has to be taken away. That's why the book value is lower. This is what the business is worth now because we have taken away the goodwill. Do you understand? The going value is what the business has now that is continuing with. The book value is what the business has when the goodwill has been taken away.
Oh.
Do you get the point here? So the goodwill
how much the business has when the goodwill is taken away.
Yeah. So the goodwill is taken away because the goodwill is for the partner that is retiring or the existing partners, excluding the new partner.
It adds value to the business.
Yeah, but now that we're having a new partner, we have to let the new partner know what the business has.
Oh.
Do you understand? So it has to be eliminated. So the goodwill has to be eliminated from the partnership agreement. So to do that, you debit goodwill account, you credit capital account with the existing ratio of the existing share of profit. With existing share of profit. Now, the new account, for the new partner that is coming in, you now credit the goodwill account and you debit capital account for the new partner. Is it clear? Do you get the point I'm making or not? When you are eliminating the goodwill, you debit the goodwill account, you credit capital account. So the goodwill is taken away from the goodwill account to each partner's account. That is the elimination. So for the existing, you will do that based on the existing share of profit. Then for the new partner, the addition of a new partner will have, so the new goodwill will have a credit entry, then the capital account will have a debit entry. Do you get it?
Yeah.
Elimination of goodwill will bring about a debit entry in the goodwill account. And for every debit entry, there will be a corresponding entry in the capital account of existing partners.
Yeah.
Now for the new goodwill, we have a credit entry for the goodwill and a debit entry for the capital account. Clear? Is it clear, please?
Yeah.
So that takes us to retirement now.
Retirement.
Yeah, retirement of.
So we're gonna go.
Yeah, before the activity.
For activity now.
Yes. So we're going to the retirement of a new partner. Are you there?
Mister, I have a question.
Yes, please.
When a partner retires, do they give him the amount or?
That is what we need to talk about here. So when the partner is retiring, whatever the worth of the business is, in turn will be credited into his capital account.
Or capital account.
So here we start. Retirement of a partner. When a partner retires, it will be important to calculate the worth of the partnership and the amount the retiring partner is due to receive. It will normally be stated in the partnership agreement. So we have our partnership agreement anyway. So as soon as a partner is retiring, we have done the evaluation.
Yeah.
We've done evaluation so that we can know the amount the retiring partner would receive. That is basically what it means. So the accounting entry for that is you debit the goodwill account, you credit the capital account for the existing share of share of profit. You know the words now. The goodwill is done. So the amount of the goodwill will be transferred into the capital account.
Capital account?
Yeah, for each partner, the retiring partner.
Okay.
The partner is going.
But who will give him that amount? The business?
The business.
But who in the business, the partnership, will give him that amount?
The business has a share of profit. They make profit, right?
Yeah.
As soon as the profit is made, they have accountants that do that.
Yeah.
As soon as the profit is made, they share it based on the share of profit.
Okay.
So the same goes to when they have to do the worth of the business. For the retiring partner, the amount that is due based on the existing share of profit ratio will be given to the retiring partner. So the accounting entry is you debit the goodwill account, you credit capital account using the existing profit sharing ratio. Now the new partners, the remaining partners that are there, you debit their capital account, you credit goodwill account for them because they still continue with the business.
Yeah.
We debit the goodwill account of the retiring partner because the retiring partner is stops already.
Yeah.
But for the new partner, for the remaining partners, they continue with the additional new partner. So it's going to have a credit entry for the goodwill and a debit entry for the capital account. Same goes to the admission.
Okay.
Is it clear? Then go to the advantages and
Can you
disadvantages.
explain them the last thing?
That's the last one here.
No, you
So
haven't.
for the explanation. So we'll go to the advantages and disadvantages of partnership.